Welcome back to the Financial Symmetry's quarterly market update webinar. This is the second quarter. This is regarding the second quarter 2026. As in previous quarters, this is about a 10-minute update of what occurred last quarter. With me today, I have Colton Tickle. He leads our portfolio team. And once again, my name is Mike Eklund. I'm an advisor and also a member of our investment committee. Jumping into the quarter, we try to keep this somewhat quick. The first thing obviously to mention is this is not specific investment advice for your situation. If you are a Financial Symmetry client, please contact your advisor for more information on your situation. Jumping forward, Colton, what are we going to be discussing today?
Yeah, just a general overview of how the market's actually performed, where that performance actually showed up at. Some of the headlines that make it so hard to actually time the market. And then again, taking it a little bit more high level at that point is keeping the perspective of the financial plan and then why we actually look to develop that financial plan and invest around the risk capacity of each unique client.
Great. Looks like a good agenda for today. So let's jump into kind of Colton, walk me through what actually happened in the second quarter of 2026 in the financial markets.
Yeah, overall, really positive returns, especially on the equity side of the markets. As you'll see, the U.S. was around 15%. International developed markets were just around 10%, with emerging markets actually leading the way. Just illustrating again that diversification is a great thing to be a part of, especially whenever markets don't move in connection with each other all the time. And then fixed income, positive, but pretty much flat.
Yeah, I mean, overall, I don't think anyone would complain about a 15% return in the equity markets in one quarter. Obviously, we understand it doesn't go in a straight line. So let's maybe step back a bit. If we would look at the next slide and kind of how has that looked over the last 1 year, maybe 10 years on the different kind of main markets. When we talk about the main markets, we're talking about, stocks and bonds here.
Yeah. So again, highlighting the 1 year return numbers there, you can see again, just the disparity against all the different markets that are available from the US market, international developed and emerging markets, but highlighting there again, the emerging markets being almost 44% over the last year. And then if you take that out to the 10-year number, just showing how strong the U.S. market has done is right around 15%. But it'll be really interesting, as you've mentioned before, how that would look 10 years from now.
Yeah, I mean, if we went back and looked at this in probably 2016 or 2006, these numbers would look a lot different. So it's just a reminder to not invest through the rearview mirror, but facing forward. So all right, so we've been rewarded over the long term, but something tells me that these markets don't go in a straight line. So tell me about, has this year been smooth sailing? It seems like it's done well, but what has kind of occurred in terms of the equity markets?
Just like every single year that there's no smooth sailing with equity investing. This chart goes through all the different events that have actually happened throughout the year. And if you see on the chart there, I mean, there's been multiple different reasons and valid reasons not to be invested. But the other thing to point out is that we still generated a positive return. The market is forward looking. So everything that has happened is already priced in. So again, it's important to try to tune out the noise over the short term to be able to capture that longer term growth in the market.
Yeah, I mean, it's been a lot between the tariffs, obviously the war in Iran, and the other things on this list. But it's important to know what the market really cares about is those future earnings. And so they feel that future earnings are still going to be strong. People are willing to pay a good price for equities. Going into this year, into 2026, one of the big talk and one of the questions we were receiving from clients was gold and silver. It had a great 2025. People were thinking they could only go to the moon. Kind of talk to us a little bit about kind of what's happened with gold and silver so far in 2026 and maybe stepping back kind of the long-term picture as well.
Yeah, I mean, if you look on the far right of the chart there, just a significant drawdown for the current year of 2026, but that longer term return of equities versus gold and silver has been quite different. So stocks won by a wide margin. The other thing to point out here is not only the return difference, but also the max drawdown and recovery of those markets. If you look at silver, the recovery took 237 months to get back to the previous high. So I couldn't imagine being invested in taking that long to actually recover. Whereas you compare that to the equity markets, it's just around three years of staying in your seat. You're rewarded to being back to recovery.
Yeah, I mean, it is kind of crazy. I mean, if you look at the long term, there was about a 30-year time period where it was before your break even on gold and silver. Obviously, the one risk there too, as we've talked about in the past, they don't produce anything where, you own a bond, it has interest, you have cash in the bank, it has interest, you own a stock, and the companies hopefully generate earnings. So that is the risk. But moving forward, what was the big headline of second quarter 2026? Of course, it was the SpaceX IPO, which went public in June of 2026. Colton, thinking about the SpaceX, are we getting a good price? Is this something that we really should be invested in?
If you look at their characteristics, no. One, their price to book is almost three times as high as the Russell 3000, and then they are producing negative earnings. So not a current positive producing company. That doesn't mean going forward that could change, but if you look back at history, just we'll go through this a little bit deeper in the next slide. But IPOs typically don't do well.
Yeah.
So.
Yeah, unfortunately for people that participated in the initial IPO, the stock is down about $25 from 135 to 110 as we're recording today on August 3rd. So yeah, that is the risk with an IPO. And as Colton mentioned, that higher price to book means you're paying a much higher price. Now, time will tell if it was, 10, 20 years from now, but that is a risk as well. So going back, that's only one example. There's talk of other IPOs, large, companies coming public here in the next year or so. Historically, has it been a good investment decision to invest in IPOs?
And this goes off of exactly the last slide that we covered, but research has shown that IPOs have delivered underperformance compared against the U.S. market as a whole. There are cases out there that they're subset of small companies or a few companies that actually have produced stronger returns than the market, but on average, you're giving up about an 8% return. So again, not trying to time individual companies or markets, but instead holding a globally diversified portfolio is how you can actually capture that return where it shows up.
Well, sounds good. Sounds good that maybe not the best decision to try to invest in IPOs. A lot of what we've been talking about is the equity markets. They seem to get all the attention. This is stocks. But there are also bonds too. I mean, a lot of our clients and individuals own bonds and cash as well. What do things look like today in the bond market? Is it a good, if I'm sitting on a lot of cash, but I might need that money in the next 3 to 5 years, is it a good time to put it to work in the bond market? It's kind of what are we looking at today?
Yeah, I mean, a lot better situation than we were 5 years ago. The far right chart there kind of shows even over the last year how yields have actually improved, especially around the 4 to 10 range. The yield curve is no longer inverted for the most part. So what you're actually achieving on yields right now are in a lot better case. So hopefully, again, if not trying to time this at any point, but again, allocating from when you actually need the money. So if you need the cash over the next 0 to 5 years, this is a good place to align your duration with your allocation.
No, that's great. So if those of you listening, if you have a lot of money in the bank account and you realize, hey, I'm getting a 0% or 1% yield on that cash in the bank, what we outlined here is the current yields on bonds, which are very close to the actual return you get, are somewhere between 4 to 5%. So it may be time to kind of reallocate some of that money for a higher return. All right, so that's the kind of the bond market. As we kind of get near the end here, one of the things a lot of people ask us is how do we decide how much should I have in stocks versus bonds versus cash? So Colton, talk a little bit about, this is a very high level outline, kind of one of the ways that we look at it.
Yeah, as I kind of pointed out, short term should be in cash and short bonds. As you kind of extend that duration, you can start looking at maybe a little bit longer duration. But further out than 7 years, typically we'll look to allocate to equities for that long-term growth within the market.
Yeah, that's great. And for those of you that are not investment nerds like Colton and myself, duration is the length of the term or the maturity of the bond. So if you need the money in the next 1 to 2 years, obviously it's a different approach than 3 to 5, and then obviously longer than 7 years, as we have outlined here, to take on more risk. Finally, as we get near the end, this is something we've included in all our quarterly market update webinars, just a little bit more about our Financial Symmetry's 3-step investment process. You can obviously look at the slide or talk to your advisor if you're an existing client. I think the most important takeaway here is if you're a do-it-yourselfer or you have another advisor, is making sure that you do have an investment plan. I have found over my many years in this business that the folks that are the most successful are the ones that have a plan, preferably a rules-based plan based upon evidence and research. But as long as you have one, you have a much higher chance of long-term investment success. With that, Colton, what is our final takeaway should we think about from today?
Yeah, I think the 3 main points, I mean, this could probably be a slide that we use at every single quarter, but headlines are noise and not signals. So trying not to, as this slide earlier showed, all the different events, and again, all great reasons to maybe not invest and believe in the market. But again, timing it is at least consistently isn't possible. Again, from there, then we look to, point number 2 is investing around each person's risk capacity. So matching the assets to when you actually need the money to help round out number 3, the volatility. So we expect the bumps and the pain in the market, but staying invested is how you actually earn that growth.
Yep, that is the price of admission. All right, to wrap up today, if you have any questions, we have our contact information on the next slide. Feel free to email Colton or myself with any questions. If you are interested in our services or an existing client, you can obviously use the Talk to Advisor link on our website at financialsymmetry.com. And with that, just want to thank you and look forward to speaking with you next quarter.